All right, good afternoon, everyone, and thank you for joining us today. This is the ad hoc meeting on Regulatory Bulletin 2025-02. My name is Lori Munn. I'm the Deputy Director of Insurance, and we are going to get started. We did have a couple people present presentations today, but before that, I'm going to have the rest of our team introduce themselves, and Dean will have a couple opening comments. Gio?
Sure. Gio Espinosa, Assistant Director for the Product Forms and Compliance Division. I'm Elena Caravetta, Regulatory Legal Affairs Officer here at the department.
Foster Burrow, Legislative Liaison.
Okay, and Ian Olzenoff, Deputy Director here at the department. Should we have a few people in person, maybe introduce yourselves, please?
Yeah, Ward Tisdale, I'm Regional Vice President with National Association of Mutual Insurance Companies. NAMIC.
Harry Hayden, Arizona lobbyist. I represent USAA and Progressive Insurance.
And I guess we'll go ahead and have the folks online just do a brief introduction, your name and the company you're with before we get started. Because since we can't see you, so we know who's online.
You just want me to call out people?
That'd be great. Pastor will call you out your name.
Presentation then real quick so I can see. All right, I'll just go down. Oh, some more people struggled it. Okay, so I'll start with the phone numbers ending in 82.
Oh, they're all muted, it looks like. Can you unmute them?
Hi, I think I just unmuted. It's Bonnie Guth at Munich Re.
Thank you.
And then phone number ending in 63.
I'll go to the next one.
We have Abu Amara. Apologize.
Yes. My name is Abir. Can you hear me?
Yep.
Yep. My name is Abir Abu Imara. I'm Director of Product Management at Geico Insurance.
Thank you. Adam Lowe.
Yep, I'm Adam Lowe, specialist with Beacon Insurance.
Angela Doss.
Hi, yes, Angela Doss, Government Relations for Nationwide.
Ann Walton.
Hello, Ann Walton. I'm with Kemper PNC.
Brianna West Jones.
Brianna West Jones. I'm State Counsel for State Farm.
Brooke Lavallo.
Hi, I'm Brooke Lavallo, and I'm an insurance analyst with the Property and Casualty section.
Caitlin Jamros.
So you can just
Right. Look, Cheryl Hawley.
Hello, I'm a senior market analyst with the department.
Claire Wendt.
Government Affairs with AIG.
And just David.
David Myers, Counsel, Farm Bureau.
Ed Mattern. And we'll go on to Emily Raymond.
Hi, Emily Raymond with Goodman Schwartz Public Affairs on behalf of CSAA Insurance.
Gabby Reed.
Hi, Gabby Reed, LexisNexis.
Jen Cram.
Hi, Jen Cram from QTech Rock here on behalf of several industry representatives and companies.
Jeremy Gerlich.
Jeremy Gerlach with Veritas here on behalf of APCIA.
Justin.
Yeah, this is Justin Brinker, Product Analyst with Farm Bureau Financial Services.
Laura Curtis.
Hi, Laura Curtis, Assistant Vice President of Government Relations with the American Property Casualty Insurance Association.
Leo Bakel. There seems to be an issue with your audio not coming in too clearly, but we'll move on to Lisa Miner.
Hi, Lisa Schlenk.
Lisa
I am
Schlenk.
an insurance analyst with the department.
Mary
Hi, I'm
Kaczynski.
Mary Kaczynski. I'm the Assistant Regulatory Legal Affairs Officer with the Department of Insurance and Financial Institutions.
Maya Agliaro.
Hi, I'm Maya Agliaro, and I'm a program associate at Series.
Michelle Baladi.
Yes, Michelle Ballady with Travelers. Thank you.
And then Paul will be presenting, so I'm going to move on to Peter Quirk. Robert Scott.
Yeah, Robert Scott, State Farm Insurance.
Roberta.
Hi, Roberta from Pekin Insurance.
Ross Lane.
Ross Lane, Government Affairs with Geico.
And this one just says SW. All right, and then Tara Mason. All right.
I'm Tara Mason with ISO.
That was everybody.
Okay, well, thank you all for attending. Hopefully everybody knows why we're here. The recap of why we're here today is the department issued a bulletin that had to deal with certain issues, some filing issues we've observed regarding some carriers embedding service contracts, services and coverages within the insurance policy. Our bulletin laid out the applicable laws that we've seen could be, but some of the products could be violated. And in the bulletin, we also committed to collaboration. And I think this is part of it. The first meeting on May 6th, we met with a lot of representatives. There was a lot of discussion. But to be honest, it was a little unstructured. So for this one, we tried to be structured. And we've asked the industry carriers representatives to present what is the arguments, what are the legal arguments based on the bulletin, what are the practical solutions, practical implications of the position, and also how it would affect insurers. And we do appreciate the two presentations today. We do appreciate that because it puts it in writing. It gives us time to look at it, to have questions, and I think that's the plan for today. The plan for today is, as the agenda states, we're going to start with APCIA's presentation. We do have a bunch of questions. Hopefully those can be answered, and then go on to the second presentation, and then we're going to have a more open discussion. And hopefully that is more structured way of, again, having things in writing, asking questions, and sort of through that process, being able to find a solution that works for everybody. So with that in mind, unless there are questions, we would start with APCIA's presentation for today.
Fausto, this is Jen Kramick, PTAC. I just wanted to clarify one point or one issue. And Lori, I know, I think Dan Rom from my office had emailed you. It is our understanding that there are going to be additional meetings after today. And so I know that we're still working on some additional materials and information that we were planning to present sometime in April. So Fausto, I just wanted to confirm with you that this isn't the only opportunity for industry stakeholders to provide information and their positions on this issue.
So Jennifer, that's correct. And today we are going to hear the presentations. We will have some brief discussions, but we are not going to finalize anything today. The intent is to have another meeting probably in another 30 days and revisit the presentations that were given today and have an opportunity for any additional presentations or comments that are submitted before that next meeting.
Okay, perfect. Thank you.
I'm sorry, to take off the presentation, I just wanted to, looks like there's a few people that are unmuted, so just make sure to mute yourself, please. And then, so we can get started. So Paul, let me just put this back up. Well, you can start when you're ready.
All right. Good afternoon. Thank you so much for this opportunity to present to the department today on behalf of the American Property Casualty Insurance Association. My name is Paul Tetro, Senior Director and Counsel. And just to give you some context for who I am and the kind of perspective I'm trying to offer today, I'm part of APCIA's Public Policy Department. And APCIA, as you probably know, represents property casualty insurers, a broad group of them. In Arizona, we represent our members, right? About 66% of the auto insurance market and about 57% of the homeowners insurance market. We also have members that provide and underwrite service contract business, and within our public policy department, I'm the staff liaison for our service contract and warranty subcommittee. So I work on both property casualty, auto, homeowners, auto personal lines issues, and I've been working on public policy issues in that regard for about 30 years. And I also interact with our members that provide service contract products and services, so I can kind of offer that perspective as well. And so can go to the next slide, please. So just to provide an overview of what I want to talk about today, just the idea that property casualty insurance and service contract are offered by different businesses that have developed products over time to serve consumers' needs in different ways. The industries have different origins. They have different entities providing their products in different ways. They've evolved in different ways. And I think the analogy I've been trying to think of one over the past few days since submitting the slides, it's kind of like the fact that you see similarities in products that, or something you might construe as an overlap. It's sort of like in the natural world where you have two, like a bat and a bird that sort of evolved to kind of look similar. They both fly, they might eat bugs, but they evolved and they came from different origins. They have the biggest point I want to make is they have different regulatory structures, which those regulatory structures have been developed separately, which I'll go into. And the sort of the biggest point that any perceived similarities or overlaps in the products that you might see, in our view, don't warrant sweeping one of the product in the regulatory system of another that was designed for another. And as I'll explain, in our view, doing so could potentially have negative ramifications for consumers, which I'm sure we all want to avoid. Next slide, please. Just for sort of a point of reference, I direct you to you may have seen it already in your background, research. It's a nice reference. This 2022 article published by the NEIC's Center for Insurance Policy and Research. We don't sort of endorse or subscribe to all the presuppositions or conclusions of the article, but as far as summarizing kind of the from a big picture perspective of how policymakers have attempted to sort of wrap their arms around the world of service contract regulation and look at it in relation to insurance regulation, provides a kind of a good reference point. So it's something that I use as a resource myself. And just to point out, one of its observations is that service contracts differ from insurance contracts in fundamental, nuanced ways, although they are similar in some respects. Next slide, please. As you're probably aware, insurance has an extensive history, well documented. In a past role, I was executive director of something called the Insurance Library in Boston, which has been around since the 1800s. Insurance, what we consider modern property casualty insurance, dates back at least till like 1666 in the Great Fire of London. In the United States, the history of insurance dates to you're probably familiar with the Philadelphia Contribution Ship, which was founded by among others, Benjamin Franklin, which is a company that's still in existence in 1752. There was a previous company that didn't survive in South Carolina. But it's a long history, well documented, and specifically when it comes to the equipment breakdown, which is one of the coverages that is implicated in the discussion we're having today. That's something that's been dates at least to the mid 1800s. Meanwhile, service contracts, on the other hand, and this is something that's referenced in the article I mentioned, have a much more recent origin, having emerged in the late 1930s to the early 1940s. Next slide, please. And likewise, the history of insurance regulation is extensive and well documented. The first state in the country to pass a law regulating insurance was Massachusetts. That's where I'm based. In 1799, New Hampshire was the first insurance department established. The NAIC, as you're probably aware, traces its roots to the National Convention of Insurance Commissioners, which started meeting in 1871. So the NAIC just marked its 150th anniversary a couple of years ago. And in Arizona, the Arizona Corporation Commission was established in 1912 that included insurance oversight, and that evolved into the modern DIFI. Next slide, please. And the point of significance is that insurance regulation is comprehensive and robust. The insurance regulation covers virtually all aspects of operation of an insurer, market entry, obviously solvency and market regulation are through the two pillars. The nationwide system that's evolved and been enhanced over time, supported by the National Association of Insurance Commissioners. On the solvency side, the accreditation program for solvency is particularly notable as far as establishing and maintaining a national framework for consistency. There's also efforts to maintain consistency and promote consistency. On the market conduct side, I mean, there's been, as I'm sure you're aware, a lot of developments in recent years when it comes to innovation and technology. And so there's a whole sort of nationwide framework where the 50 states all have insurance departments that support each other and are likewise supported by the NAIC. Next slide. Service contract regulation is very different from that. For the most part, over history, the service contracts were obviously subject to the same laws and regulations as all contracts, common law, contract law, and the development of the Federal Trade Commission. It's not unlike in the insurance industry. The service contract industry doesn't have the exemption provided by the McCarran-Ferguson Act, for instance. But this issue of where service contracts begin and insurance ends and service contract begins is something that's been discussed as a policy matter for a long time, and as described in the paper I referred to, and is laid out in the NAIC's deliberations. The NAIC took this up in the late 80s, and that developed the adoption of the NAIC's model law on service contracts in 1995. The stated purpose of which was to create a legal framework within which service contract may be sold. Next slide, please. Here's the definition of service contract in the NAIC model, which is similar to what is in the Arizona statutes, except for significantly, the NAIC model specifically defines, which is in the subsequent slide, mechanical breakdown insurance, and in the definition of service contract specifies that service contracts do not include mechanical breakdown insurance or maintenance agreements. Next slide, please. And you don't have to read this, but this is the definition referred to in the definition of service contract in the NAIC model. So, next slide, please. So getting specific to Arizona, as the general law, I'm sure you know, the Arizona Consumer Fraud Act, the statute which we're here to really focus on today, and then the regulations that were that have been adopted pursuant to that statute. And this is the dates there, the references I got from, I think, LexisNexis and also the NAIC's tracking document. So that's, to the best of my knowledge, those are one of those. I believe there may have been some updates to Chapter 20 subsequently, but at least those, my understanding is the initial adoptions for those provisions. Next slide, please. So again, the statute that is quoted in the bulletin has been the subject of what we're talking about today, and notably, in contrast to the NAIC model, doesn't specifically exempt or refer to them to insurance, equipment breakdown insurance, or insurance by any other terms, but rather has language which can be it's certainly understandable, the reading to sort of apply to possibly when you look at the items that are covered by the definition, sort of understandable to where we are having this discussion today. If we go to the next slide, please. But the question I think we want to raise is, when you think about the whole robust scheme of insurance regulation that has evolved, is when the Arizona legislature adopted that provision, whether or not that it was more it's something. Another reading would be that the description was meant to refer to what it kind of existed already in the marketplace, rather than to say that anything that covered those items is subject to this regulation that's in the regulatory scheme set out by these regulatory provisions. And the question would be, whether or not the intention was for coverages which had been offered for decades, more than a century, frankly, would need to be removed from those products, or subject to as kind of a dual regulation under what was being established, this the permit requirement for service contract providers, or whether or not or whether that was not the intent. Next slide, please. And then the other question that we really want to encourage folks to consider, what the effect of such interpretation would be. We have members who are asking questions about why there's a different approach for coverages that have been offered for decades, again, reaching into the multiple decades, hundreds of years. And the question would be whether or not if the regulatory approach to require either removing those and filing them separately, or subjecting insurers that are already subject to the broad and robust regulatory scheme of insurance regulation as licensed insurers, require them to submit to a separate permitting scheme that they're might not be familiar with, because it's not something that they've dealt with. What their reaction to that would be, whether it would result in possibly those coverages being removed from products so that there would be less robust coverage, or if it would just be something that a regulatory requirement that would just add cost to the system, resulting in inefficiency. Next slide, please. So our view of it was that there really wasn't a concern from our perspective, whatever 4 months, I don't know if it's 4 months, 6 months, what the actual timeline is, but sort of whatever we might define as a status quo of how things were approached and how things are treated nationally. I mean, all states have basically a separate regulatory structures, even if there's as many states do. The regulatory regime, is under the insurance department. That's the regulatory authority for regulating service contract, but there's no other state that we're aware of that is taking an approach similar to require property casualty insurance companies that offer these kinds of coverages to subject them to what was otherwise enacted as a law to apply to the service contract industry. But if there's perceived persistent, statutory problem, our suggestion would be to look for a statutory fix to sort of allow the regulatory separate approach to prevail, which can be done in a couple of different ways. One is laid out here to sort of just add within the definition of service contract in the statute to specify that it doesn't apply to to an insurance policy as defined by 1102. I believe that there's also within the service contract statute provisions, one of the latter provisions is specific exemptions, and so you could put something in there as well. So there's a couple different ways to have a legislative fix rather than sort of have impose unprecedented requirements that are on existing market participants. Next slide. That might be the last one. Thank you. Yep, happy to entertain questions, and I understand you already have some prepared, so do my best.
Thank you, Bo. I'll start with, I guess the big question is, and correct me if I'm misinterpreting the position, but practically the position that you've advanced is insurance companies should be allowed to offer these services, even if these coverages might be triggering a permitting requirement for a different entity, right? Because you can have overlap of a coverage for a key fob, let's say. A lot of companies are saying we can offer that as a coverage, but then you have to acknowledge that that also triggers a service company requirement. So when these two coverages, exactly the same coverage, one is offered by a service company, this one is offered by an insurance company, I guess the presentation is sort of saying that we can do that. That's allowed under the law.
Well, I guess I would, what I'm saying is that in our view, the statutory structure should allow the coverages that have been offered traditionally by insurers to continue to be offered without triggering an additional permitting requirement. That would be, I mean, I guess I'm starting, there's two ways of starting from a policy perspective of what is the best way to approach it versus when you look at the statute, and if you kind of sort of come up with a reading that may trigger something that's may not be the best approach.
Okay, I guess that's where we're sort of struggling with. If we acknowledge that the definition of insurance, a contract of insurance, is this general broad statement that is a contract for indemnification, and you can offer a slew of coverages under it. But then you have this more specific statute that is a completely different scheme, and it's a different regulatory framework. So how do we go about when a coverage triggers two separate statutes? For us, it was hard to sort of say that, well, only one should apply. Again, if we get back to, I mean, this is hypothetical, but I don't know if we can argue about a key fob replacement. That directly triggers service contracts. So you have this coverage in an insurance policy, but you have this coverage in a service contract. How do we bridge that gap of these are two separate frameworks that apply to this one coverage? It's the same thing. It's exactly the same one. I guess from a statutory perspective, my question, I guess, is the suggested resolution is sort of exempting.
Yeah, I get that. Is, I mean, I think we're acknowledging that, for instance, if the NAIC model has an exemption that specifies that it doesn't. That my reading of the statute, suggests to me that it could be read as being, as I said, descriptive. Where if you think of the legislative intent, that okay, so when the legislator said, okay, we want to have something legislatively on the books that applies to what's in the marketplace, separate from insurance service contracts that are offered, that the description. A written contract for separately stated consideration for any duration was meant to describe that, but I'm just suggesting that it wasn't meant to apply to what was already in the marketplace for insurance, already offered by licensed insurance companies. But just so if there is a statutory, like if there's a perceived need to read the statute in that way, then our suggestion would be a legislative fix to sort of to address that, so that it's not so it's clear that that separate permitting requirement isn't triggered. So because that's what you're saying, like your hypothetical states triggering is happening, and I'm suggesting that we would want to see the statute amended such that it was clear that triggering wasn't.
Okay, can I just one more? So if the statute does change, it will codify sort of this exemption of, but also it still affirms that there are such things as service contracts and service contract coverages. So if you include a service contract coverage within the policy, would that be reported? For example, premium tax, would that be reported on that for that coverage? Would it be listed as an endorsement? How would it be presented to the consumer? Because again, we do acknowledge no matter what the change is, it's not going to get rid of the service contracts framework.
So,
right?
so I'm sorry. So a licensed insurance company offers a coverage that, arguably or hypothetically, for the sake of argument, fits within the current statutory definition of a service contract.
Exactly.
And it's for which would mean for a separate consideration, right? So it's not an add-on coverage that was not part. It's laid out in the as a separate item in a deck page and whatnot. Because if it's offered, because if it's sort of lumped in with the rest of them, then it wouldn't trigger the definition, right? It wouldn't fall within the definition. But if it's if it's something that, okay, here's what here's your auto policy liability, blah blah blah, and this is a specified coverage that's sort of separate from those standard coverages or comprehensive class, and then a separate line. So with that, and that's sold by a licensed insurer, I mean, that would be insurance premium. So however that would be treated by taxation. So yeah.
And you're saying it'd be broken out as a separate line on the deck page to distinguish?
I'm saying
that?
it would only become considered a service contract under the existing statute if it was sold for separate consideration, right? Because that's part of that definition.
Not to interrupt you, Paul, but if you want to comment or have a question online, if you could just raise your hand so we could acknowledge you. That way we're not interrupting the speakers. Thank you.
And yeah, if we can finish with sort of this with questions to Paul, and then Jen will get to you. But again, though, the potential fix and the one proposed would sort of say, okay, we acknowledge that there is such thing as a service contract, but other than the insurance policy, so you're excluding an insurance policy from having to require to be permitted, right? So if it's sold in an insurance policy, it's not a service contract. However, like I was going back to saying, it's still, service contract industry will still exist, and they will be offering these coverages that are still meeting the definition. But when you're sort of taking this, you're exempting yourself from a permit, but you're still offering a service contract provision coverage. Would those not be, and I guess that's the question, are they going to be separated? Or how are they going to be presented to a consumer? Is it just another coverage? Is it just comprehensive collision? Is that how it's going to be presented? It's going to be lumped in, or is it going to be differentiated in some way under the proposed solution? If this proposed solution becomes law, how would those be presented? How would claims for these coverages be processed? I guess more of like a practical side from the insurers.
Well, as they have been. I mean, my understanding is that what I'm advocating for is a status quo position, not a change in business practices. I'm saying this is the structure and approach that I'm advancing is what's done in every other state and what has been done in Arizona up until the matter of months. I guess it's on hold now. So it is. My understanding is it's a status quo position. So well, first of all, if the coverages that we may be talking about would have to be offered, specifically with specific, for separately stated consideration, in order to arguably fall within the current definition of the service contract statute. So I'm assuming that we're talking about that's what's already being done, because if that's what's at issue. Because if it's not, then it wouldn't meet the current definition. I hope I'm not talking in circles. It kind of sounds like I am in my head. And so, but to go back to the status quo concept, I mean, whatever's being done currently for claims, it's just as any insurance claim would be processed. And as far as like what consumers knowing, I mean, service contracts and insurance policies are, offered at different times by different providers. So the fact that there can be some similarities, and it isn't necessarily we don't view that as a point of confusion. If somebody has an insurance policy that provides and also a service contract that may provides similar or benefits, then that may be beneficial. I mean, it should all be a matter of consumer choice and decision making.
So Paul, basically I'm just going to recap is that you're not really offering a statutory change at this, what you're saying, just continue status quo?
I'm saying that, I'm suggesting that status quo from what has been the status, the way the approach of this for the past 10 years more, it would be the way to continue. But my understanding is that the reason that there has been discussions in previous meetings, and the issue resulting in the issuance of the bulletin, and the point of this meeting is because there's been a reading of the statute that that there's kind of an inconsistency and that would require a statutory amendment to maintain what I'm describing as the status quo in order to alleviate that inconsistency is not quite the right word I'm looking for, but the fault being identified probably in the statute.
And Paul, if I could jump in here real quick, I'm going right off of your proposed revision. I just have a quick question on that. It sounds like by the proposal, or at least one of them, because thank you for the suggestions. I mean, certainly this is a conversation, but is to then call, and I'm going to be general here, call what the industry insurers are offering, those coverages in that bundle or whatever it is, contract or agreement, and to pull that from the service contract world, not just the 1095 regulatory scheme, but from calling it that. I think your presentation included affirmation that these entities, these beings are different. Insurance is, is a little different than a service contract or an agreement for repairs and maintenance generally. So this revision to me looks like it's saying other than service insurance policy, that in this change you're proposing we don't even call what you're doing or what we have an issue with a service contract. So it sounds to me like that is correct.
Because it is in industry jargon, including by the that would offer certainly more clarity. Yes, rather than an approach that sort of talks about service contract coverages within an insurance policy. That to me is would be confusing. It could continue in ambiguity.
Okay, is it perhaps? Could it be confusing to a consumer, though, who would think that their insurance policy is still a whole, and then you throw in elements perhaps of utilization that wasn't assessed for risk, and then could potentially skew renewals, cancellation? I mean, is that going to be something?
I'm not sure I follow. I mean, to my understanding that just as far as like terminology and clarity, that any of the coverages that might be sort of implicated by the regulatory approach that's been talked about, it has separate, sort of titles like mechanical breakdown, key fob replacement, if there's without using the word service contract. So.
Well, and going off of that, let's start with your status quo that you've noted. If perhaps there's hypothetically a concern for consumer confusion, that's kind of where I'm going with that. So if someone has the mechanical breakdown and they're using it, is that, I'll make it easy, is that something they could be non-renewed for or canceled for, the use of that type of coverage, not service contract, that coverage? Is that something that the industry would cancel or non-renew for, the usage of that, similar to the use of, the zero deductible glass coverage, for example, which is on the, the deck page, and that's a coverage. Would something that's separate, it's not a traditional insurance policy per se coverage, is that going to be similarly, assessed in pricing? Is that going to be substantiated? Would that be something that will go against their risk factors as a consumer at renewal?
Claims, is it counted against claims is what she's trying to get at.
I mean, in a nutshell. Because, for example, you could have two consumers that one consumer purchases a service contract from the same coverage as from a service permittee. And then my neighbor purchases it from an insurer. I may potentially, depending on how this question is answered, pay more for my insurance, even though apples to apples, I'm the same, same risk presumably, because the usage I have for my service contract from an entity who's a permittee is not being looked at by my insurer. Certainly, there would be a kind of a uneven risk assessment there for the homeowners. I'm just wondering, and again, there's not an answer I'm expecting from you. I'm just considering that might cause consumer confusion in and of itself if carte blanche we call those coverages part of the insurance policy and pull them completely out of the realm of service contract. Permit or not, assuming, let's say the permit, we're going to resolve the issue with no permitting, but the consumer confusion continues to be a question that we have.
Yeah, I definitely would want to defer and get back to you with, my sort of general understanding is that most of the coverages that I think we're talking about are offered at really pretty low, added expenses compared to the cost of a policy. And I never heard of them being, if I can remember, we're getting attention for being the cause of cancel, non-renewals or whatnot. But I certainly couldn't make any blanket statements about that. But it would I guess from what I understand, that would kind of surprise me. It's not compared to things, risk factors that we normally think about with homeowners and auto insurance policies. I don't think that they're significant cost drivers or significant movers of underwriting behavior. But I would, it's the kind of thing I would definitely, want to offer. Just that's kind of a very qualified, like consult with members and sort of
I appreciate
the conversation.
I'm sorry, I didn't mean to put you on the spot, Paul.
I'm here to be put on the spot. That's fine.
Okay.
And Gio, would part of the concern be that essentially it would be same coverages, one offered by service companies and others issued by insurance companies? So it'd be kind of same coverages, but potentially different standards applying. Is that
possibly
part of a concern as well?
I'm not sure. I heard the concept of you could have coverages that might be similar being offered by different entities. Was that posed as a problem or?
Well, I think it goes back to like the key fob example. So you have it in your insurance policy, but you may also have it in a service contract or, you know, a warranty that you purchased with your car.
Right, right. And
So that
I
there-
certainly, if I was a consumer, if I had purchased it, a certain coverage, at the time of purchasing a car that was a service contract, sort of something that was sold at the dealership, that might fit within the service contract world. And then subsequently I was buying, insurance and it was offered as a coverage for an added cost. I would decline it, so that would be but if somebody, ended up with, certainly, I don't think anybody's, well, I shouldn't say that, but.
So Paul, that's kind of the key right there where you said I decline it. In some cases, we've actually seen these embedded in the policies, which is what's kind of started the conversation. Because if it's not endorsed in an optional coverage and it's embedded in the actual policy, the consumer has no option to decline that coverage. So
Well, can I ask the question, if it's embedded in the policy, then is it offered for a separately stated consideration, or is it not? Because
no, normally if it's embedded, it seems like it's included in the base premium.
Well, if that was the case, my understanding was that wouldn't therefore fall within the Arizona service contract statute.
But if I could just butt in here real quick, because I want to go back to what Elena asked, because Elena's question was specific to the coverages are the same here. It doesn't matter what it's embedded or not, rider or not. The coverage, if we're taking an example to a key fob or whatever, is the exact same coverage, but now there's two different statutory standards that are being applied just depending on how it's being sold. Same product, basically.
Listen, Jen, listen,
So that's
this is not meant
we
to
have-
just be a conversation with Paul. I think this was intended to be an opportunity for everybody that's on the call to weigh in. There are several people raising hands. I think other people would appreciate the opportunity to provide perspective, experience, and additional information that relates to the presentation, that relates to your questions. I'm not trying to cut Paul off. I'm sorry. I'm not trying to interrupt you. I just think there might be some good dialogue here if somebody other than Paul was given the opportunity to actually interject and be part of the discussion.
Jen, I appreciate you raising that concern. We do have open discussion listed in the agenda after both of the presentations. So we want the questions asked first, and we want this dialogue with the presentations for the people who offered to present, and then we will open it up to those who have their hands raised. So Paul, if you want to go ahead and respond to my question.
I'm sorry, I forgot the question now.
Okay, so it's specific to, Elena asked about the coverages. Basically, you have the same coverage. One's offered in a service contract, one's offered in an insurance policy, but now there's two statutorily different regulatory frameworks for that identical coverage. Could you respond to that?
Yeah, I don't necessarily see that as a concern. I don't know the extent to which they are always identical. Even to a certain extent, you might argue that the fact that they're subject to different regulatory schemes might mean that they're sort of different in a sense of for instance, when it comes to solvency protection and guarantee fund protection under an insurance policy that might not exist under a service contract. I don't know, but so it's sort of, I don't want to fight your hypothetical, but but assuming I'm not sure that things that are pretty similar at that level of product offering, from two different entities is necessarily a problem. And also, well, yeah, I guess I'll just leave it at that.
So Paul, but there is the permit issue though, when one does have to have the whole permit to operate and sell those coverages versus the insurance not.
So I guess that's from a starting point, our perspective on the insurance regulatory regime would seem to be more than adequate to provide consumer protection such that that any product offering by a licensed insurance company would be would have all the legal protections that might be necessary for consumer protection, would not require subjecting to the separate service contract permitting.
I think we have one more question Dean's going to ask, and then we're going to move on to the next presentation.
Yeah, and I thank you, Paul. Yeah, and again, this is a conversation. We're asking questions. I guess talk about status quo. things are at status quo right now. So currently, how is this coverage? Is it differentiated in any way? Is it used for underwriting, for rating criteria? How are insurers using this? Again, PFOP, like these coverages that could trigger something else, how are they being used? Are they being used just like liability? How are they being used, I guess, if you can tell us that? For underwriting, for risk factor analysis, are they being used for that?
I'm not equipped to answer that, right now. That might be that kind of gets to operationally versus the more general that I'm able to speak to. Sorry.
It's up to you if you want to open it now to them or if you want to save it until after the board's presentation.
Let's hear the next presentation because there might be some additional conversation that comes from it. And then we'll open it up for across the board. I think that will be best so that Ward has enough time since he came in person.
I'm very glad Paul went first. He took a lot of the general stuff. I just have really 3 or 4 points to make. And
Or do you want to introduce yourself?
yes, I do. I also, I would encourage that if during your questioning, if people on the phone want to weigh in, I think it might help the dialogue, but it's your meeting. I won't do too much on that. Thank you for the opportunity to present. My name is Ward Tisdale. I am with the National Association of Mutual Insurance Companies, regional vice president. I do advocacy in the Southwest, Arizona, and neighboring states. I'm based in Austin, Texas. I can tell you a couple caveats. I am not a lawyer, so we're not. If you have intense legal questions, please don't ask them. I don't do deep dives on the service contract issue in general, but I did ask for member feedback on this issue and got some of that from our members, and just wanted to go through a few slides and we can have a discussion and hopefully a much larger discussion. So, Fausto, this will advance. Yep. Woo! Look at that. All right. So NAMIC, Paul mentioned, the extent of their purview. We have many common members. We work very closely together with APCIA. We have about 1,300 members, 6 of the top 10 property casualty insurers, and you can see our numbers on market share on auto and home in the business markets. I'm doing dual things here. Okay, so from the substantive policy statements that came out, I believe April 25th, and we thank you for that, by the way, that, there was obviously some confusion about this issue with members, and so we're glad that you kind of stepped back and came out with these statements, aka bulletins. Really, there's kind of 6 takeaways that I got from them. That DIFI was seeing that unpermitted entities were engaging in conduct requiring permits, and I think we've already covered who that is. That's insurers, and that you were noticing these service contracts being in policies through filings. DIFI wants collaborative solutions to ensure insurance service contract market participants in compliance with the law. And I think that's really what's sparking these discussions. And as you mentioned, there was one in May that I attended as well. While there were some enforcement actions, I believe, taken, you kind of put the brakes on that and said, let's have dialogue, let's discuss this. And no actions would be taken until January 1st at the earliest of 2027. And that DIFI will not reject form or rate filings on the basis that it may contain service contract coverages and policy endorsements. So there's sort of a stay on that activity, and that you're having stakeholder meetings again May. We're now in July to continue the dialogue. So that's kind of where we are today. So, question: is residential equipment breakdown coverage insurance, and it's our, oh, going on two different things, sorry. We believe, based on the definition of insurance, that this is insurance and should be regulated as such. Paul mentioned that on the national level, this kind of coverage has been going on since the 1800s. And so we feel like this is an insurance product. It should be in an insurance policy. Is it property insurance? Yes, we believe it's property insurance. Equipment breakdown coverage pays for accidental direct loss of covered property caused by mechanical, electrical, or electronic breakdown, rupture, bursting, bulging, implosion, or steam explosion. Can you hear?
The online, they're having trouble hearing you.
Oh, okay. Well, I can move.
The room usually is pretty good with
No,
that,
I've had
so-
gotten feedback that they can't hear very well, so.
Okay, just speak up a little bit, maybe. We have a speaker here and there.
Okay.
Yeah.
Got it. So we believe it is property insurance as defined by Arizona law. So again, cutting really quite to the chase. You know, this discussion today, the discussion we had in May, there's a lot of ambiguities in the law. There is disagreement about what it is. When that happens, I know you're a regulatory agency and you have to enforce what you believe the law is. That's your role. If there's a policy decision to be made, then that's really the domain of the legislature. If we have confusion, let's fix it. And we have a few suggestions on that front. I want to do a quick check. Does everyone still hear me okay? So in the section of law that has exemptions for service contracts, let's just insert language that says service contract provided within or as part of an insurance policy issued by a property and casualty insurance company would be exempted from service contract regulation. In addition, in section C, this would clarify that it is insurance. The types of agreements referred to in section, except for service contracts that are provided an exemption, are not insurance, and are required to comply with insurance laws of the state unless the provision is made expressly applicable. So these very minor, direct, simple legislative fixes we think could be very helpful and removing the confusion that is currently exists. I do want to express a couple of other concerns I heard from members. One was equal treatment. There was a carrier that had to stop offering equipment breakdown coverage, and then when the process was paused, they weren't able to have it, but other carriers living under the pause could offer it. So I think carriers are just really looking for some guidance. And as far as the hidden coverage, I guess complaint or allegation, the members that I've talked to, they offer it as a separate endorsement, equipment breakdown coverage with a separate premium. So it's very transparent what the coverage is, how much it costs, and then it is sold via endorsement. So, in conclusion, I do want to thank DIFI for opening this dialogue and having these opportunities to present and air out the differences and the positions of insurers and other stakeholders. Insurers really do want guidance on this. You know, obviously the legislature just left town, but if we can reach some sort of agreement absent that, that's great. But the third point I want to make on that is that the needs of consumers are paramount. We want to make sure that whatever the policy is, particularly if there does need to be some sort of legislative fix, that we just put the needs of the consumers at the forefront. What is going to be best for them? how is it going to simplify their purchase of these products? And lastly, the legislative fix, it's not a huge hurdle. There's some simple language changes that can be made, and we could get to them where we need to get. So that is my final comment. Thank you, and happy to answer questions. Again, have several of our members online. If there's something that I'm not comfortable answering, I'd like to open it up to the floor.
Thank you, Ward. I think what we'll do, Fausto, we just thought it'd be best to wait for you all online to comment until after we heard both presentations, because there could be some overlaps, and I think this is a more efficient way. But we will open it up now to you all to comment back, and then we can take it after and wrap up. Fausto, do you want to just start calling on folks that had their hands raised?
Yeah, Jen had her hand raised first, so Jen, you can go ahead.
Thank you. So again, we're still working on finalizing our comments that we wanted to provide holistically, but just to address some of the points that Paul raised and some of the specific questions that you had for him. Our position on this, or if you look at the history of these two types of products, service contracts or service companies were more recently created as an alternative to insurance that allowed for more limited specific reimbursements at much lower price points with much lower coverages than what could be afforded and provided by a licensed, funded, reserved insurer pursuant to an insurance policy. From our perspective, and I think which is consistent with Arizona's insurance code and the laws of several other states, is that these are intended to be two different types of products that are offered and provided by two different regulated entities subject to those different requirements. Louisiana's Secretary of State regulates service contracts. They're not even regulated by the insurance department. Several states, Texas, California come to mind, regulate certain types of service contracts under a different agency than the agency that is responsible for overseeing the insurance industry. So from our perspective, they are okay to operate and to coexist because they are, while they may touch the same underlying subject, they are two different products, two different permits, two different licenses, two different sets of regulations. Arizona is just a state where the same agency happens to regulate both. We think that this is supported by the language of 20-1095-10 subsection B, or the entirety of that statute. Subsection B says this article does not alter or diminish any right, privilege, or authority granted to any insurer under any section of this title. Conversely, subsection C says that all service companies operating pursuant to a permit are exempt from the insurance code except for those statutes that are specifically made applicable. So the language of the statutes themselves contemplate that two different regulated bodies can operate in the same space, offering different types of coverage for the same underlying hazard or risk. The most common example that I can think of is auto glass. I can buy a service contract for auto glass. As an insurer, it also has to be offered as part of your policy. That doesn't mean that an insurer has to get a service company permit in order to make that mandatory auto glass coverage. It's part of a comprehensive policy. And I know that there are some questions about how is it reflected? How is the premium charge for that reflected? How is it handled in terms of underwriting, renewal, premium? And I think those are some questions that, again, we want to dig into more deeply and can address when we do our presentation. But I just wanted to point out that I don't think that what is happening in the market today, what is happening in every other state, and what has happened or how these products have been regulated historically violates the existing statutory scheme for either product. And again, I just want to point out that, you know, while you can buy a key fob service contract that may entitle to you to one fob for up to $50 in every 12 months. That is not how key fob coverage replacement under an insurance policy works. So again, they are different products, different coverages, different set of regulatory schemes. And our position is that that is okay. And that is what is contemplated by the insurance code, and more specifically by the service contract statutes within our insurance code. And I know we're running short on time, so I'll stop. Thank you for letting me weigh in.
Thank you, Jen.
Ed.
Yes, this is Ed Matern from Farm Bureau Financial Services. I was one of the guys that did not get unmuted in our initial introductions. There was a question about whether equipment breakdown coverages would claims would result in surcharges or non-renewals of policies. And I was just going to point out that carriers can state in their filed rule pages whether or not certain types of claims are surchargeable. And I know we try to not get into company-specific information in this type of setting or meeting, but carriers do indicate in some cases that equipment breakdown coverages are not, claims rather, are not surchargeable, as stated in the filed rule pages. And I don't know about key fob coverage, but that would be something that if carriers are not stating that in their rule pages, they could add that to the rule pages, filed rule pages that state that those types of claims are also not surchargeable. So that should answer one of the questions that was brought up during the APCIA presentation.
Thanks, Ed. And then we just got another, Mary.
I just have a question about service companies. Okay, so I'm assuming everybody here is an insurance company and weighing in on whether or not they should be required to have a permit. But have we heard from service companies about, you know, if I'm assuming key fobs have just started showing up in insurance policies or not, or maybe in the last couple of years, it's just started showing up and we're seeing more and more of that. So, and I agree with Jen that these are, you know, two separate industries, but, you know, it seems like one industry is really encroaching upon the business of another industry. Are we, you know, we have any plans to invite the service companies to weigh in on this issue at all?
So Mary, this is Jen. To that point, we represent several service companies and we've provided them with copies of the bulletins and then, you know, opportunities to participate, and will continue to do so. And I would actually counter your point and say that the service contract industry has actually technically arisen out of an offshoot to offer a less regulated, lower level type of coverage from insurance. So the nature of service companies is an offshoot of insurance. So I think the perspective that insurance is encroaching on the service company industry is it's actually the reverse. So again, we're going to address this more globally, like how did these laws come about? But it really was created, service companies were created as an opportunity to have a lower regulated, less financially onerous opportunity to provide consumers with a lower limit, lower coverage, much smaller reimbursement type or service, you know, benefit, rather than that historically having to be made available through an insurance policy.
And Mary, just so you know, I'm sorry, I did reach out and invite the service contract industry to attend these meetings as well. I reached out to their organizations that they have, such as NAMIC and APCIA, and did send them invitations to join these meetings.
Thanks.
Yeah, it's just, I would add to that. So I think I said at the beginning that we have members who offer service contracts as well. So, you know, to a certain extent, we're representative of part of that segment, and we're not, you know, the idea that there's a concern among about encroachment isn't something that we're aware of.
Can we go back to that question, the operational question that Paul was not able to answer? Whoever can answer, this question about how is this type of coverage utilized in underwriting, rating, non-renewal determinations, more of an operational? I think that was claim. I know I talked about claims not being sort of dinging you, right? But what about everything else? Underwriting would just how is this operationally? Is it being differentiated or is it just being lumped in with the rest of the coverages of an insurance policy?
Fausto, this is Jen. I don't know if that's company specific. I'm not in a position to address that globally or sort of make a blanket statement. But again, I think to answer part of your question, right? If the department's argument is that anything that can be offered by a service company, such as auto glass, requires a separate permit, right? Like, look, carriers deal with auto glass now. That's a mandatory coverage that's used in underwriting. I don't know that it's the same across the board or with respect to every type of coverage that can be made available or coverage for every specific type of quote consumer product, which is what the service company statutes use. I will take this back and that is certainly something that we will get feedback on and see if we can provide you with some more specific data points. But from our perspective, that's potentially an area where maybe this is something that the department and industry needs to focus on and maybe address or adopt a uniform standard moving forward.
Thank you, Jen. And again, there's a bunch of carriers here. Can we hear from anybody else about operationally, right? Status quo, current.
I think there may be some concern about like antitrust or trade secret. So that's why I don't know that you're likely to get specifics on an open meeting.
Yeah, thank you, because I meant to bring that up before we even started this meeting. I wanted to bring up the antitrust because we do have to be careful.
Yeah, that's yeah,
And Jen, thank you so much. I think that I'm nodding over here when you speak because I know that you've got to take these conversations back. And I think that getting, not narrowing down then the concern or the question that I'd want to see is I'm a consumer and I quite frankly would probably trust my insurer to offer these types of coverages for me. I'd be confused as a consumer if the utilization of these coverages impacted my traditional homeowner's policy or my traditional auto policy. So those are the type of questions that I'm completely fine getting more information about, specifically to, underwriting the risk, the utilization. Especially things that aren't necessarily insurance by definition, right? Because if we're talking wear and tear, that's not typically insurance. That's typically excluded, but that's something that's covered in some of these contracts that we've seen filed with us. And so, that the surprise element is what I would have a concern with, or what I'd want to hear more from you in your presentation.
Yeah, and I appreciate that. Again, I can't speak to any one company or an industry standard specifically. Again, I think from my perspective, and if you look at this as how is, well, I'm just going to stop there. I appreciate that. I've got lots of notes on this. We're going to take this back, see if there's something that we can get either de-identified or sort of aggregated and provide that to you, or bring it up at the next meeting on this topic. But I do think there's something to be said, right? To the extent that those anticipated claim costs are actuarialized and built into premium and are part of a comprehensive policy, that is impacted underwriting with claims. I think that's a point that I'm going to take back, and we're going to see, what we can get for the department, and we'll do our best to provide some concrete information, or at least raise this as a talking point if that's the place where we need to look at some uniformity or some additional disclosures to the consumer. So I appreciate that.
And I don't think, we're asking for anybody to indulge their secret sauce or how they do it specifically. I think what we're looking at is, again, the inconsistencies we're seeing with some of it being embedded in the policy and some of it being endorsed where it can be in more of an optional coverage. And so how are those treated if you're endorsing mechanical breakdown or, key fob and some other different services via endorsement that an insurer is aware of and can decline versus it's being written as part of a clause in the actual contract or policy itself, that cannot be removed unless you're removing it by endorsement, and they have that option. And I think that if you guys could distinguish that, that's what we're looking at.
And then, yeah, I did want to add on to kind of that piece too, Lori, because that kind of goes back to exactly what Paul was talking about, where if I understand correctly, his current reading of the statute was that it needs to be, if there isn't a separately stated consideration, as if it is embedded within the policy, then he's reading it as it doesn't currently fall underneath that framework. But Jen, as you mentioned in your initial comments, is that some insurers are offering it as a separately stated consideration on the declaration page as an endorsement or rider. So you see, that's kind of where the issue where we're falling in here from is where I think that the current statutory framework, as Paul presents, and I agree that his fix would fix this, that well, now it's kind of presented as, well, this one, because it's embedded, is insurance, so it's not under this framework. But because this one is an endorsement, it is a service contract, and there's an issue there. I think somebody else raised their hand, so I didn't see who it was.
It was Ed.
Ed, did you want to add something else?
Fausto, if I could just respond to your last comment.
Go ahead, Jen.
From my perspective, whether a coverage under an insurance policy is embedded in the policy or added as an endorsement doesn't change whether it is insurance or a service contract. Again, I would point to auto glass as an example that it's still insurance if it's as if it's included in the policy through an endorsement. I think the department has raised questions globally about should the industry be treating these types of coverages in a certain way. Consistency, uniformity, industry standard. Is there a way to improve consumer education, explanation? I think those are some questions that I think are worth more exploration or discussion. And again, I don't know if there is a standard or if there is inconsistency in the industry. It sounds like there may be, based on the comments that you've provided and some of the filings that you've seen. But I just want to clarify from my perspective, the mere fact that auto glass is added to a policy as through an endorsement doesn't mean it's now a service contract coverage. It's still insurance.
And Jen, what the examples was more around the confusion on the consumer side and how it's being utilized versus, if it's in the policy itself. Like I said, there's no opportunity for an insurer to say, I don't want that coverage, I don't need that coverage, and are they being penalized for having that coverage if they use it? I guess that's kind of what we're looking at versus an endorsement. They can decline an endorsement or not want, say they don't want that coverage, and it's clear because it's listed out on the deck page that is separate coverage versus embedded in the policy. How many insurers actually read their policy and they may not even know they have those coverages, or if they use them, how it affects them?
And Lori, you make a good point. And I just want to go right back to Jen and Lori's comment here. And while I agree that auto glass is a little bit of a different example, but I want to make sure that we're clear that I still have that question as far as wear and tear, right? That's not traditionally insurance. There is no fortuity there. It will happen. Mechanical breakdown, it will happen. So I disagree that, or at least I want to make sure that I understand. You had mentioned, Jen, that it's insurance. If it's embedded, it's automatically an insurance coverage. But then I would question again, the consumer would not know that something that's wear and tear that's not traditionally included under an insurance policy, under my homeowners, that could cause me to cancel. I just want to make sure in that consideration, when you guys discuss this, that there's some kind of component for what is impacting underwriting, what's impacting costs, and whether or not it is separate, completely separate stated consideration, because I don't think that the consumer confusion issue would be solved by just because it's embedded, it automatically is insurance, which I think is a stretch there, because I don't know that we can say that those factors aren't going to affect underwriting or cancellation or non-renewal for use of something like refrigerator protection or microwave protection or dishwasher protection, things that are not generally insurance. And I don't think even the status quo was allowing that.
I think we do have someone, Emily.
Yeah, hold on. Nate was trying to unmute himself, but he wasn't able to. But I did just want to respond just real quick before we jump on Nate. Jen, I appreciate that response, and I don't think we're trying to say that like the auto glass stuff that's specifically allowed for within statute, right, is like not insurance, because the statute does require that to to be offered. But I was kind of getting at more what Gio was saying specifically about wear and tear, not like the consumer issue, but like, you know, like for those things that are traditionally service contract, like wear and tear, right? Or you know,
traditionally an exclusion.
Is how would you, you know, because going back to Paul's point again, it was like just because it was embedded versus not being embedded, whether it triggers that or not. So that was I was trying to get at, mainly from like a, you know, from the statutory construction standpoint, was an issue from trying to regulate that. But let me go ahead. We have Nate
Brown from Progressive. I'm sorry.
Go ahead and put him by that.
Couldn't get on Google Meet, so he called in, and then he, his phone wouldn't unmute, so he couldn't ask any questions or make any comments. So, okay, go ahead, Nate.
Hi, hopefully you guys can hear me. I could hear you guys, and was trying to use the calling number, but it was not, I was muted somehow. So anyway, the point I wanted to make is that these offerings are transfer of risk. And so, you know, the cost associated should be related to the risk that is, you know, understood by the customer. So, for example, if they use their product a lot, the cost should go up because they're claiming a lot. Now, I think there's another issue here, which is probably because this is embedded in an auto policy per se, or a home policy, will the other coverages be impacted? And I think if the department has a concern around that, I think they should, you know, maybe put forth that as the issue. But if, for example, you're just talking about the amount of usage of a key fob, you lose 10 of them, yeah, your rate should go up. You know, I think if the concern is more so what happens to the underlying liability policy, then would be helpful, I think, to the conversation if the department would state, hey, that's where their concern is.
Yeah, I think it was.
Thank you, Nate.
Rounds.
I think we have time for one more question, and then we're getting close to the end. So we'll wrap this up, and we'll have a few closing comments and what next steps are. So is there just one, Emily?
Yeah, just Emily.
Yeah.
Hey, everyone. Thanks so much. I just wanted to clarify, because I'm hearing a lot of the scenario of a service contract being embedded in the policy versus an endorsement. And I actually got my homeowner's insurance renewals months ago, and I saw a separate page of additional endorsements that you could purchase. And to me, it was very clear as a consumer that it was not expected that it was included in my policy. It was addition to, and it was very thorough. But I want to make sure I understand that those endorsements are also an issue for the department, right? Folks who were just offering those endorsements were still flagged under this, correct?
It was not specific to like, I'll just answer that question. It wasn't specific to like the endorsements itself. It was just the coverages that are triggering the service contract, however they're being offered, whether they were embedded or not. What I was bringing up with the endorsement piece was because I was connecting to what Paul was saying, where he was kind of honing in on that part of the definition service contract that says for a separately stated consideration.
Right.
So if it was an endorsement, that it would be listed separately on the declarations page, as you're mentioning. So that's why I kind of brought that up, but it wasn't specific to one way or the other. It was just in general, the provision of these coverages within an insurance contract, however they were being offered.
Gotcha. It just sounded like the concern was more significant related to the embedded nature of it and not knowing if that impacts the policy. And I wonder if we could more hone in on that versus the separate endorsements.
Yeah, and I think the embedded piece kind of more goes to what Gio was talking about with like the lack of the disclosures, because there are certain disclosures that are required within service contracts, and like, you know, if they don't know it's embedded, but I'll let her kind of speak more to that.
That was more, I can take it if that's all right. That was more what we were getting at, is some are embedded, some are endorsed. And if it's embedded, they're not always aware. Like I said, not everybody reads their policy. They may not even know they have the coverage, or if they do, how it affects them. But it's the same, and you can't reject it like an endorsement, but that's more just the consumer knowledge and them knowing what they're getting and how it affects them is why we brought that up. And Gio, if you had something else to add.
No, I think it's just part and parcel of the conversation, and I appreciate that comment, but we didn't, you know, look at one differently than the other. I think this was a topic we wanted to address, but I can certainly, some of the questions I have in terms of what does that risk, the transfer of risk, what does that cost? What does that look like? In a separate endorsement certainly would be easier to ascertain than something that was embedded, and the status quo is not even to disseminate or to determine whether it's a service coverage or not. But I think that it went as to both. But I do think that that's something for further discussion. What does that look like when it's separate? And then I know we ran out of time. I don't know if Nate has the ability to answer a follow-up question. Carrie, he said.
I'll call him right back. Hang on.
Okay, and I can maybe check offline. I just wanted to know, he had mentioned that certainly if the person gets 10 key fobs, that they should potentially.
He's on now.
Hi, Nate.
Oh, there he is.
Oh, thank you for your comment. I wanted to know, so in your example, you had noted that if someone uses the key fob 10 times, that certainly that would be a higher risk, a higher cost. Did you mean just for the coverage, the fob, or the overall policy?
Well, I think that's the issue that I think the department needs to take a stance on to try and help us understand the statutory change that's required here. Because I think, you know, carriers will do it different ways. But I think that level of clarity will help in crafting a legislative fix that addresses your concerns potentially, and we'd like to work together with you on this. So I think understanding if that's your concern would help us craft a set of regulation or statutory amendments that fit the bill.
Thank you, Nate.
All right, yeah, we're just right at time, so unless there's any other comments, we don't have to start right at 3 because I did note or on adjournment of this one.
Potty break. Potty break.
Okay, you guys just want to take a 5-minute break and then or so, and then we.
So, well, we want to kind of wrap this one up before we start the next one.
Looks like there's no more comments, so.
So you want to just. So we appreciate the presenters today, and obviously all the comments and everybody participating and having this open dialogue. Next steps would be for us to, you know, take in everything that was said, and we ask the same from all of you. It sounds like there are folks that are, you know, digesting what was said in the presentations and some of our questions. And we will schedule another meeting in probably about 30 days to continue the conversation, hear from you all on more about, you know, what are the next steps? Where do you all see this going, and what do you plan to kind of do once we have follow-up conversations? So this was again to hear the presentations, to kind of get feedback, for us to take it back and discuss, but we want you all to do the same. And ultimately, you know, we're hoping that you guys are gonna kind of let us know where you see this going. So with that, I know we have another meeting at 3:30 scheduled.
3.
3? Oh, it was at 3. We were running right into them.
Yeah, that's good.
So I guess we will adjourn for about 5 minutes for those of you that want to stay on for the next one that is on the advisory organizations and the risk service organizations. And we'll come back at, start that at 3:07, let's say. Gives everybody 5 minutes.
Sounds good.